this is the time to buy. If you don't know how to survive in a down market, then you're not a real estate investor.
We met at a networking event. You said that you met your partner at a networking event. Like, how valuable do you think networking within the real estate industry for people that are listening that maybe are anxious or nervous to get themselves to one of these events? Like, why is it so important for people to get to these events?
Welcome back to the Peak Profits Podcast. Today's guest is Aaron Fragnito, a full-time real estate investor, co-founder of People's Capital Group. Aaron manages about $8 million real estate portfolio across New Jersey and has completed 300 plus real estate transactions and has helped more than 100 clients invest, build, and preserve wealth through real estate. He's also the host of New Jersey Real Estate Network, the Passive Cash Flow Podcast, and an Adjunct Professor at Rowan University, where he teaches real estate entrepreneurship. Aaron is deeply involved in educating both passive investors and active operators across the New York City and New Jersey markets. Aaron, welcome to the show.
Thanks, Brian. Glad to be here, my friend. How you guys doing today?
We are doing lovely, and it is a pleasure to have you on. We actually just met not too long ago at a local event here in Manhattan, and was pleased to see that you were an operator in New Jersey. You know, a lot of people in this business, or a lot of people that we meet at different conferences, are operators in the South, or, you know, maybe doing deals in some of the Sun Belt. And so to see someone doing deals in the local market of, you know, the New York, New Jersey metro. I'm from Pennsylvania myself, born in North Jersey. So I've been around this area my whole life. And so it's good to see someone doing deals. So I'd love to get into it and learn a little bit more about you and what you've been doing. But you guys have a long history, you and your partner, in People's Capital Group. So can you tell us kind of how you got into it from the beginning and kind of when you started this all?
Sure. So I read the Purple Bible, Rich Dad, Poor Dad, 2009, graduating from Rowan University there as an entrepreneur major, and dismal job market. You know, went to the job fair, and there were two companies hiring. You could sell insurance on 100% commission, or you could work at Enterprise Rent-A-Car, and where they start you with cleaning off the cars. And you know, I was like, hey, I don't know. I just didn't have passions for either one of those. No offense to either one. I probably would have done great selling insurance, actually. But it was just not the avenue I wanted to go. So I knew I wanted to own large-scale real estate. Didn't know how to get there. I was a broke college grad. I moved out to Steamboat Springs, Colorado, and taught kids how to ski for 6 months. And I read a bunch of more books on real estate investment, and kind of plotted my plan of attack here to move back to Jersey and learn the industry, which I did as a realtor, got my real estate license, and kind of cut my teeth that way. I met a lot of investors. I got very comfortable with short sales and REOs. I got into flipping single family homes and just started speaking at a lot of local real estate networking events. Eventually started my own real estate networking event with my business partner, Seth Martinez, who I also met while I was speaking at a real estate networking event. And he had sold a medical billing company, so he was very liquid. I was moving a lot of deals as a realtor. So we complemented each other's strengths and weaknesses. And so in 2013, we teamed up to start People's Capital Group. And we bought first property was a 6-family that we bought from a We Buy Houses sign. I used to staple to telephone poles in the hot August sun in a suit and tie for some reason. And that worked back then. We get a lot of calls.
You always wonder who's behind those signs, because a lot of people hang them, but you're one of the guys, right? They call you.
I'm the guy, yeah, one of the guys. There you go. Yeah, the cops would be like, "You take that down." I get like calls from the city, be like, "We're gonna fine you." I was like, "You'll never catch me." So they worked really well back then. This is like 2012, 2013, and people would call because no one was buying real estate back then. Like now you put up We Buy Houses sign. I don't think anyone's going to call because it's pretty easy to sell your real estate. Although I don't know, I haven't done it in a few years. Maybe we'll get some calls. But
maybe we do an experiment. Let's go hang some signs in North Jersey.
There you go. And so I got some deals that way. A lot of short sales, a lot of properties. I would wholesale them. I'd fix and flip them. I buy them. And we found a 6-family, Seth and I together that way. We bought it for $220,000. Put about $60,000 into it, renovated it up, leased it up, and refinanced our money back out completely in about a year. And we grew from there. Started buying more and more multifamilies, buy, renovate, lease up, rent, repeat, with the BRRRR strategy, right? And so we were doing it before there was a cool acronym for it, the BRRRR, and just realized pretty quickly, it's a very cash intensive business. So we started to invite other investors to invest alongside us in these opportunities and buy bigger and bigger properties as we raised more and more capital. We developed our in-house property management company in 2015, and just continue to grow from there. And together, Seth and I, we've done about 300 deals together, fix and flips, wholesale, multifamily. And now we focus on buying about 40 to 150 unit buildings here in northern New Jersey. We've always stuck to North Jersey. I think 99% of our transactions are in New Jersey, if not Jersey, like Philadelphia, so pretty close, And that's what we really focus on. We know the market here well. We have the infrastructure in place. We understand how to navigate, the red tape in a blue state, and we've done pretty well for ourselves and our investors through the years. And a lot of investors that work with us like investing locally. About 75% of them are local to New Jersey here. And they like being able to drive by the property, see the property. We do walkthroughs with them. It's a tangible asset after all. So that's a nice advantage where when you're investing 6 or 7 states away, you really don't always know what's going on in your asset. And we feel like we can control the assets and the projects better being near them.
Aaron, we met at a networking event. You said that you met your partner at a networking event. You also run your own networking events. We were at one last week as well. Like, how valuable do you think networking within the real estate industry ultimately is? And why should people be putting themselves out there and getting to more of these? I mean, the obvious answer is you met your partner there. You've probably met investors there as well. But like for people that are listening that maybe are anxious or nervous to get themselves to one of these events, like why is it so important for people to get to these events?
Well, as the saying goes, it's all about who you know, not what you know. And that really rings true for real estate. It's, especially if you're raising private capital. I mean, you have to be in front of people. They generally want to see you and get to know you. In fact, even someone I met at the event we met at is considering investing in one of our opportunities, right? So that was a great event. We met each other and I met other potential investors. So great opportunity there. It is so important to be out there in front of people. Learning how to do public speaking is very important. Basically, most of what we do, whether you're talking to one person or 100 people, you're pretty much public speaking. A podcast as well, right? All this is public speaking. So learning how to do that well and kind of honing that art is important. But I think this would ring true for most industries. Knowing the right people will allow you to just flourish, and putting yourselves in rooms where you're surrounded with the right people is very important too. I have to say, for years, I also went to real estate networking events. And I did raise capital from this, but you're surrounded by a lot of people that are kind of trying to do it themselves. Maybe they're like, wannabe real estate investors and landlords and house flippers, or maybe they're struggling and don't have a lot of liquidity. And it took me a little while to realize you really actually want to put yourself in rooms that you're surrounded by people with a high net worth and perhaps no desire or time to do what you do. If you go to a real estate event and it's all real estate operators, like a good one of that, which I think has value, is the Best Ever Conference, which I went to and pitched my deal at last year. Now, I learned a lot at the Best Ever Conference. I learned what other operators are paying to raise capital. I met service providers that can help me raise capital. I met competitors that are crushing it and what they're doing to thrive beyond the levels that our goals are to reach that level. So I learned a lot from the event, but it was an industry event, right? And you don't want to fill your calendar with industry events. Like, how many of my competitors do I really need to meet and talk with? Probably 3 days of that is enough. What I should fill my calendar with is family office events, registered investment advisors, yacht clubs, jets and planes and country clubs and things you're going to meet high net worth individuals at, if your goal is to raise capital, which of course is what I primarily focus on in the company here. So, and people at those events really aren't going to be running a real estate investment company, right? And like, if they are, maybe that's few and far between. So my value is more recognized in those rooms because I have this skill set, this experience to find great off-market deals and pull together capital and do the underwriting with my team and acquire them and reposition them with our management company. And that's a skill set and that's an infrastructure I have that I can bring to the table, that if I'm surrounding myself with other people that have the same exact infrastructure I have, well, what value do I really bring, right? So actually it's about networking. Yes, it's 100% about getting out there, networking, knowing what to say when you meet someone as well, but also putting yourselves in rooms that are filled with the people you really actually need to meet.
I think that's really well said. And it's interesting to think about, because a lot of times the local real estate meetups, like you said, will be local fix and flippers, people focusing on residential, maybe 1 to 4 unit duplex, triplex, dipping their toes into it. But if you're getting to deals or to meetups with people that are high net worth and they're extremely good at their job, you could provide them with a really quality investment that you guys are controlling, right? That you do a really nice job in, that they might not, have the time or quite honestly the desire to go out and look for that stuff. And so they'll place capital with you. And we find a lot of times that our investors at 7P Capital are high net worth, successful in tech sales or in the technology space. A lot of the major 5 companies, Microsoft, Salesforce, Google, a lot of people from those companies are looking to invest with us because they do very well, but they have a high demanding job, working 40, 50 plus hours a week, a lot of times in sales or as engineers. And they are heavily weighted in technology already, whether it's through their ESPP or RSUs, and they're trying to diversify into tangible assets, be it real estate. So it gives them a really good option to kind of track the deals that we're tracking and the partnerships that we're getting into. And so you mentioned there, you focus in New Jersey, which is a highly competitive, high barrier type of market, and you're finding off market types of deals. So you've been doing it now since 2013 with a lot of success. How do you guys find the deals that you find, and what is your focus is kind of mid-scale 40 to 100 units? You mentioned multifamily, which I'd imagine is probably difficult to find also in North Jersey at times. So how are you scaling and finding your deals off market, and what does that look like in your process today?
Sure. So one of the reasons we focus on this market here is because we have so much experience here and we have the relationships, right? So once again, when you're raising capital, it's important to have those relationships, but also when you're sourcing deals, right? Like a broker, when they get a good deal, they don't want to just like blast it out and put it out to the entire market or whatnot. They usually bring it to their A buyers. They don't want to waste time with tire kickers or buyers that can't perform. So they're going to have that list of A buyers. And you have different types of brokers too, right? You have brokers that focus on serving the sellers, and they might put it out to many, many, many buyers and try to get lots and lots of bids. Then you have brokers that really focus more on buyers, and these brokers are going to bring you great deals. And we the deal I'm buying right now is a deal in receivership. The lender is in foreclosure. The owner's in foreclosure by the lender, right? So, and the lender doesn't want to kind of air their dirty laundry. So they're not putting it out all over the internet and LoopNet and whatnot. It's a kind of a whisper campaign. It's a pocket listing by the receivership company, which is managing the property. We knew a broker who knew the receivership company. So we got in on the deal. We got in there quickly. We've been negotiating with the lender for over a year and finally got them down to the price we want to be at. But it's not like there's a bidding war going on. We're the only buyer on the table. And the best deals I've ever bought are the deals where I'm the only buyer or like one of 2 buyers on the table, right? So when you can eliminate all the extra bidders, then you get the best price possible. And that proves true for almost any time you're buying something in most any asset class. So that's it. It's the relationship-driven business, the brokers, the wholesalers, the landlords, the attorneys, the receivership companies, lenders. These companies and these groups and these people bring us these deals. They know we perform. We've been doing this a long time. The networking group helps. You guys saw there were a lot of realtors there and lenders and like attorneys. So that's the people that come to our event. Like, oh, these guys are like local market professionals and they have capital behind them. They can buy my deals, and great. I'm going to bring them my deals like first and try to, just not waste my time running around with a million buyers. So that's it. And then when you perform for those realtors and those wholesalers and so on, then they bring you more and more deals, and it becomes a nice relationship.
I absolutely love how you talk through that approach, Aaron? Like when you talk about the lenders not wanting to air their dirty laundry, I think if you really think about that, the lenders are essentially saying that they may have made a bad decision by lending to the previous owners, right? And they don't want to openly and publicly announce that, and therefore that's why it's such a great avenue to target the lenders in these situations. And ultimately, you mentioned that you've actually been negotiating this for over a year. Can you talk us through that a little bit? Because that's a long time. A lot of people would have given up. A lot of people would have turned to new deals. So can you talk us about talk to us about that negotiation process, and then maybe if you could just kind of talk through the deal in itself, that would also be amazing.
Sure. So this deal was brought to us, I believe, the very beginning of 2025, if not like the end of 24. And the lender wanted about 20.5 million. I was like 18.3 million. And I said, okay, good luck, and kind of let it go. It's important when you're buying a property to know that time is on your side. I'm not the one owning the property. I'm not the one with the non-performing note. I'm not the one trying to figure out how to get the C of O for this property and get it leased up and somehow get this property off my books. I'm out there buying real estate. Like if I don't buy this thing, it doesn't cost me $1, right? And the word no, as I said at the event there, has never lost me money. The word yes has lost me money, right? So as the buyer, you're really in control and time is on your side, right? There's never like a deal I didn't buy and I'm like, it's like, whatever, deals come and go. And at that time, I let time go on. I didn't really think much of it. And then the deal came back around about a year later, and the building was starting to get stabilized. It was actually a much more attractive opportunity now because it's about 85% leased up. When I was first underwriting it, it was like 40% leased up. So now it's, in a much better position. And they wanted 19 million. I came up to 18.5. Well, at first I said, okay, my offer, they're like, can you still do the 18.3? I was like, no, my offer is 18 now, which is a good trick. Whenever the seller comes back to you a year later, they still want that offer, be like, no, the offer is lower now, and then they're, oh no, then they're really pissed. And then when you've come up to the offer you initially had, they're happy and they'll take it, right? Great negotiating tactic. And they were at 19, I got them down at 19.7, 18.3, and then I was like, I'll do 18.5, I'll meet you in the middle. So we met at 18.5, and then and now we're just doing our due diligence. We're pulling together the capital amongst our investors. We have 113 private investors, about an 83% reinvestment rate. We have a handful of investors interested in this one, family offices, high net worth individual accredited investors. We're raising about $6.4 million. Actually, we have some 1031 capital coming in, a number of 1031 investors on this, which is interesting. So that's a great source of capital as well. And what was your second question?
Just a little bit more about the deal itself, Aaron. Honestly,
Sure.
I just love the way that you explain like the whole negotiation process as well. You make it sound like this is just so easy, like you're just a duck kind of swimming along this pond, but I'm sure underneath you're kind of kicking your legs as fast as you can, scrambling around at times. But in front of them, you're just this cool, calm, collected Aaron who's like, nope, the offer's off the table now. We're lower. It's just amazing. But if you could talk about the deal, that would be
sure. Yeah, one of the things I love about Class A real estate is that it's brand new, right? All new appliances and plumbing and electric and the roof and so on. And I'm so used to buying Class C real estate, like old 90-year-old, pre-war buildings. And we just bought a 42-unit in Passaic last year, and we're putting few $1 million into it, and it needs work. All the electric, you open up a wall and it's like, oh, there's the downspout that needs to be completely replaced. Basically in every floor. It's just ongoing stuff. That a 90-year-old building is going to have, and it always pretty much costs more than you think it's going to cost, and therefore takes longer than you think it's going to take. So Class A is nice. I really like Class A. The only reason I don't own more Class A real estate is because for the last 6 years, Class A has been extremely expensive with compressed cap rates and just overpriced real estate. And now with rates being higher since 2023, prices have come down about 20%. And here we are with this window of time that you can buy Class A real estate for like a decent cap rate and a decent price. So we're taking advantage of it. There's also a lot of developers that over leverage themselves. This developer owes $22.5 million to the lender. He probably put another $3 million in himself, right? He's probably in this thing for $26 million. We're buying it for 18.5. Huge discount below replacement cost. So it is that type of market right now. And those are the types of deals you want to find that, and there's a good amount of developers out there that are in a tight spot, because a lot of these guys, they underwrote it in 2019, 2020. Interest rates were like sub-inflation. They probably have doubled since they underwrote the deal. Rents were growing at 8% a year. Cap rates were at 4%. So it was just like a crazy hot market with super cheap money. And they probably underwrote it with those assumptions. And now, 5 years later, and the inflation hit, and the COVID with the delay of materials. So now you're waiting for all your construction and the labor. And it just was like a perfect storm for these poor developers. So a lot of them are in a tough spot, and they are motivated. In fact, it doesn't even matter how motivated they are, because they're handing the keys over to the lender. And now you're negotiating with the lender as we are, right? So that is the market we are in. It's not going to last forever. I think there's a year where you can take advantage of these opportunities, where you can buy deals for ridiculous discounts to replacement costs. And then, rates should continue to kind of slowly tick down a little bit, and probably not get down to like, COVID levels, but like, reasonably. Cap rates might compress a little bit. So, we'll go back to a bit more of a normal market. But yeah, rents are soft right now. Prices are down. And this is the time to buy. It's unfortunate a lot of equity is nervous and kind of on the sidelines, although that is starting to change. But this is the time to buy, man. You got to buy when the prices are down, sell high, buy low, and now it's low. It's time to buy.
That's very well said, and it kind of fires me up, because you obviously know your stuff. And like anything, real estate is very cyclical. It goes through its market cycles, and everyone wanted to buy in 2021,
right,
when rates were 3%. Cap rates were super compressed. People were paying top dollar. And it seems like a lot of operators, a lot of fund managers, and people within the business kind of scattered and got this shiny object syndrome, and maybe went to buying businesses or crypto or something else, because real estate isn't on fire right now, right? You're hearing some of that blood in the water with some of these, as you put it, these developers that kind of got into some hot water with kind of how they underwrote their deal, as well as some of these operators and multifamily operators. But if you have a clear plan, vision, and some conservative underwriting, you can get into some really solid deals right now. And we've seen your deal that you have in Newark, and it's brand new. I think it was 2024 build. Yeah. It's beautiful, right? And so it's very exciting that you're getting a essentially brand new building for less than replacement cost from the lender. Right. So you're obviously going to do incredibly well in this deal. I'm confident in it. Obviously, once you close, that's when the work starts. But obviously, with your track record, I have no doubt. But you do a lot to help your investors. So can we talk a little bit about, you talked about raising capital, a little over $6 million for this deal. That's no small feat, right? To get this thing closed, that's a lot of money. Yeah. So you raise that capital, you help your investors. How do your limited partners and your investors have a part in this deal with you, and how do you help them at People's Capital Group?
Sure. So we created, Reg D 506C. In this case, the PCG Fund 4 is the name of the entity we create to buy one single property. And in this case, technically it's 3 properties, but it's one closing. So investors own, shares or units in that LLC. And, there's a PPM they sign to get ownership of it. And they get all the benefits of owning real estate, such as tax depreciation and cash flow and equity growth, and what we do with the refinance and the sale to harvest that equity growth over time. And they're protected by owning a part of the real estate, right? So they don't have to sign for the debt. They don't have to deal with the day-to-day management, managing the property. They get monthly updates, quarterly financials, monthly cash flow distributions, ACH right to their account. And, annual tax, K-1 tax forms done for them as well. So we try to create a nice, easy, hands-off system with a lot of transparency and communication as well. And it's super important to communicate with your investors, especially when things aren't going exactly to plan. And it happens, right? Projects slow down, they go over budget, things like that. But you want to always explain to investors, and not come to them with the problem, just, oh, here's what happened, we went wrong, but come to them with the solution. Say, here's what went wrong. A contractor didn't show up. We hired a new one. The project got delayed 4 weeks, and here's how we're going to, make up for that. Or here's the plan now to make sure we get back on track. It's super important to have that communication in place. So we really work hard at that with our monthly updates that are very in-depth with pictures and videos, and our quarterly financials are very in-depth as well. We have in-house bookkeeping here, and try to get our K1s out very quickly too at the end of the year. I know it's important for fund-to-fund managers like you guys, and to get those K1s out quickly so you can then get them to your investors, and to our investors as well, to get them out there quickly. So it's how we structure it. Not much different than most syndications. We do a preferred rate of return, generally 7 to 8%. We do a waterfall split after that, 70-30 or 80-20, depending on the investment amount, the share class you're in. And we're targeting IRRs in the mid to high teens on this, ARs around the mid teens as well. We'll cash flow from day one, monthly distributions, and then do a refi, go from a bridge to perm loan around month 18. And plan to get about 45% of investors' capital back at that time. And then we'll most likely sell at year 3, month 36. That's the plan. So kind of have 2 nice liquidity events, one halfway through the project, one at the end of the project, and then cash flow from day one around 4 to 5% a year.
You spoke a little bit about having kind of vertical integration. Mm-hmm. Aaron, can you explain to those people listening why being vertically integrated helps you ultimately in reaching those projections that you shared, right? How that helps supporting managing the day-to-day. You just mentioned that limited partners aren't having to deal with any tenants. They're not having to put any of their kind of down payments down. They're investing in this LLC. And beyond that, their responsibility is ultimately reading a monthly update, checking their bank for the ACH payments every month, and reviewing the financials every quarter, whilst really that's everything they have to do. So can you talk through the kind of value of being vertically integrated?
I think it's almost everything. I mean, you can buy a bad deal and make it into a good deal with the right operations. You can buy a good deal and make it into a bad deal with the wrong operations. It doesn't really matter what markets you invest in. Obviously, there's boom markets and there's markets that are slower. But for the most part, if you buy right and manage right, most of the time you're going to do pretty well in real estate over time. What really matters is the operations. And so, yes, it's extremely important. The first deal we ever bought was a 25 unit in South Jersey. And it was about 2 hours from where we lived. So our contractors were driving back and forth 2 hours. At first we hired third-party management companies. One of them was a well-known national management company. They managed tens of thousands of units, and they assured us they would do a great job. And then we bought it, and they were managing it, and it stuck around 75% occupancy. And they're like, well, it's South Jersey. What do you expect? And we're like, you didn't pitch us that when you were trying to get our business. You told us you'd be at 95. And so then we went the opposite end of the spectrum. We hired this small mom and pop management company and met him at a local diner there and gave them the business. And then he really insisted on having the security deposits. I need to have the security deposits. And I just got a bad feeling about it in my gut. And I was like, nah, we're going to hold on to the security deposits and we'll release them, as need be when tenants require them or whatnot, and they move out. He's like, I really need the security deposits. I don't know if I can do without security deposits. And then he ended up meeting tenants at the property, leasing up the unit, getting the first month's rent security deposit. And then he would meet another tenant at the same unit, lease it up, get the first month's rent security deposit. He would do that for 3 or 4 tenants, pocket the money, and ran off. We had to take him to a small claims court. We won $8,000. Big waste of time. And we realized, we're like, okay, if we switch management companies for a third time now and end up firing them and go to a fourth management company, our tenants are going to lose faith in us and our investors. And you need a happy tenant to make a happy investor. So we realized at that point, we need to develop our own management company. And that was in 2015. And it was tough. And it's still tough. Management of real estate is really frustrating business. It's like not a fun business. It's a thankless business. There's no real margins. We don't make any profit on our management company. We only manage our own assets. It's just it's a tool to make sure our properties, our assets are being run well, and that we do what we say we're going to do for our investors, and we hit the mark on our projects and our buildings. So it's really everything. It's operations. I mean, there's buildings I wish I paid less for, sure, but in time, usually that gets cured, and it's all about knowing, the people you're hiring, the boots in the ground, the service providers, and that's why like going to another market would be tough too. Like we've worked so hard to create this infrastructure here, and I really don't want to go rebuild it in another market. It's like a ton of freaking work and risk, and I just have no interest in that.
Yeah, I mean, I'm just like smiling behind the camera here, thinking and hearing you explain all that, because I was going to ask a different question and maybe pivot, but now I just want to stay and swim in this for a second, because so many people, like, real estate is so sexy to talk about and buy and own, and like, I have this portfolio and real estate is like the best thing ever, until you buy it and operate it and have to deal with actual people living in your units and having to collect rent and deal with all the stuff that can go wrong, especially at scale, right? And so that's why we so often talk about, like, do you want to be an active investor, or do you want to like invest passively with people like yourself who are doing this day in and day out full time to manage these properties and ensure that you're taking care of all that stuff on their behalf? Because people are like, yeah, I'll buy this rental property right there down the street, I'll put a tenant in it, and then I'll just forget about it and it'll just pay me. I'm like, right. That's not necessarily how it works, right? And so I think maybe people will buy a single family or a small duplex and test the waters and try to understand it. But I've also heard a lot of people that have struggled with stuff like that because they don't have the time to manage it every single week. And then you talk about third-party management nightmares. And I've heard of that a million times as well, because it's like no one's going to care after your property to the same level of detail that you're going to care after it, right? And they're in the business to make money, to fill units and, drive revenue for their business, but they're not going to care for it the same way you do. So I think all of that was well said. I think it puts a lot of thought into people listening on how you want to take this whole real estate investing path. And do you want to scale your own personal portfolio and put in all the time and effort that it takes to do so? Or do you want to really just spend the time to do due diligence on high quality operators that are buying high quality deals and invest in something like your Newark deal that is a brand new asset that you clearly have a strong plan in place for? They, instead of putting maybe $100,000 in a down payment on a $400,000 duplex, they can give you $100,000 into this deal and, sit back, have your contact, be in touch, see your monthly updates, and quote unquote, get mailbox money or electronic money monthly. Right. And so I think you just put a lot of that into perspective, and people need to think about how they want to invest in real estate if this is the path they want to go. So now to pivot slightly, is you do work with a lot of, family offices, or you mentioned real estate investment advisors. So you work with like larger capital groups. Do they look at their priorities differently? I know they do, than maybe retail investors, and like how reporting, or do you have to do things differently when you talk to potentially family offices or institutions, if you raise from institutions, versus your standard accredited investor, retail investor that might just be high net worth?
I mean, the reporting is pretty much the same. We're going to send out the same financial statements, the same valuations of the assets, the net asset valuations, the monthly updates, quarterly financials. I mean, the difference is probably in the due diligence phase. There's definitely, if some family offices and RIAs and institutional capital that prefer is much deeper due diligence, always for institutional, much deeper due diligence. And however, there's two types of family offices, right? So there's single family offices where you're basically dealing with the patriarch of the family who's built, normally built the company from the ground up, or like kind of took the family business and built to the next level, ideally. And so they might understand the industry they're in, but they don't always understand real estate. So, and they're also like, business like experts and entrepreneurial minded. So they do kind of trust their gut. It's a lot of relationship business. It's not all that different than someone writing a check for 50,000 or compared to someone writing a check for, 5 million from a family office. For the most part, if it's a single family office, it's a pretty similar conversation with pretty similar due diligence requirements and everything. I mean, we have the whole due diligence vault. We have the institutional level underwriting model. None of that's going to change. I'm going to send them all the same information I'm sending a private investor that I am a family office. The difference with RIAs, okay, now the second type of family office is a multifamily office. A multifamily office is a collection of smaller family offices, and generally there's a head RIA, registered investment advisor, who basically works kind of as a gatekeeper, wealth manager, who's going to underwrite all the deals coming in. And his or her job is basically to like cover their ass, make sure they don't pick a bad investment, and lose the family office's money, or they'll be fired, right? They're basically like a hired person to kind of manage, the multifamily office. Now there's input from the other family offices and so on, but it's basically managed by an RIA. So this person is really just looking out for themselves, and like they want to remain in their job. So they're like super conservative, and they're not going to want to take like any risks, and they're much harder to get through. I don't really have a lot of success with multifamily offices and RIAs. I do find them more difficult to solicit capital from. Where a single family office, we kind of speak the same language. They respect like our scrappiness and entrepreneurial mindset because they have the same. They've built up their own business in whatever they're doing, and they recognize that in us, and they appreciate that. And they're like, that's what I'm investing in. Where an RIA will be like, well, the market didn't grow by 6% last year, so now I'm not going to invest because this decimal point isn't where I want it to be. And you're like, all right, bro, whatever. So, and that's the difference, it's one is their actual own money. This is their own money, the patriarch of the family office. Another is a person hired to protect other people's money, and that's fine. They're doing their job, and they're not willing to take risks, and often not willing to then therefore grow at the rate they need to grow at. But that's kind of the difference I see.
That's really helpful insight, Aaron. It's interesting that even though the value of money that can be invested could be significantly different, right? Like 50,000 to 5 million is a massive swing on the scale. Ultimately, you're giving the same level of access, the same level of due diligence. You're giving the same level of reporting, the same level of financials back as you would to these high net worth individuals or family offices. And I think that's what even retail investors need to think about, is you are getting access to opportunities that the high net worth people and family offices are actually looking at, right? Like it is an incredible way for you to build, grow, and ultimately protect your wealth as well. And you do a lot of educational pieces as well, Aaron. You also educate at the Rowan University. Can you talk a little bit more about that and what you share with your through your real estate classes and real estate entrepreneurship?
Yeah, so I graduated from Rowan University in 2009, and they asked me to write and teach a course about 3 years ago called Real Estate Entrepreneurship. And at first I was like, no, I don't have time for that. And then they came back to me and they're like, we can't find anyone who's actually doing it to write and teach this course. And, colleges want people, they don't just want like a real estate attorney. They want like a guy who's actually out there raising and buying real estate to teach these courses. So it made sense, and I was honored to do it. So I actually just did it for one semester. It was a great experience. I am considering at some point or another potentially going back. It is a very serious time commitment, but they have the course now, and they can, have it taught there as well. So I think if I did it again, I would pack less into it. I taught these students how to do fix and flips, how to do wholesaling, how to raise money, how to do real estate syndication. We touched on short-term rentals and long-term, the whole thing. And it was a lot. And I always said, I'm going to be one of those teachers who really engages the students and gets them up and standing up and running around. And I realized I wasn't really that type of teacher because I had so much information I needed to convey to them, that it was like, it was a lot, so I was just kind of preaching to them the whole time. And, but it was good. I think they learned a lot. Rich Dad, Poor Dad was one of the books we read, and a few others as well that were kind of like very like in-depth industry specific books. And I got some good feedback from it. but it was a serious time commitment, and especially to write the course, and teach it as well. But a great experience. Glad I did it. And we right now, so I also do a monthly podcast, the actually bi-weekly podcast. The Passive Cash Flow podcast is our podcast there. I do about 8 master classes a year. Those are online, webinars that are about an hour long that dig into specific topics around real estate and investment. And those are generally on the last Wednesday or Thursday of the month for about 8 months of the year. We do 4 in-person events a year with New Jersey Real Estate Network. That's 2 big like biannual industry networking events. That's the one you went to just the other week in January here that we do in Jersey City. And then that kind of kicks off the year. And then I do another one in June in Somerset, New Jersey. Same thing, the biannual real estate networking event. And then I do 2 building walkthroughs. So we'll do that one in spring, one in fall, and we'll walk investors through our buildings and show them how we renovate them and reposition them, why we're doing it, how increasing revenue by $1,000 equates to $50,000 in value creation and whatnot. The explaining kind of how that was multiplied exponentially on properties. So and just kind of going to the why, how, and where, and digging into the deal. So that's cool too, because real estate's tangible and you can walk people through and explain how you're doing it and why you're doing it. And so a lot of investors really enjoy those building walkthroughs. We get our hands dirty a little bit and show them how we reposition these old buildings and make them new. So that's what we focus on. We don't sell education. It's all free.
I love that. And I'm sure that's exactly the reason why you have such a high reinvestment rate. I think you mentioned 83%. Right? And you've done a really nice job since 2013 of scaling People's Capital Group and kind of the holdings that you guys have now, and really just looking at your portfolio and scale. Right, this new asset that you're closing on, I believe it's 63 units, brand new Class A, beautiful asset. So the ability to now kind of come from where you came from in 2013 to now buy a brand new 63 unit asset in northern New Jersey for the quality of the asset and for your investors is really says a lot about the growth of the company, which is exciting. And I think also getting in person, like we mentioned earlier in the podcast, going to events, going and doing your live webinars, those 8 times a year, those masterclass, like all of that stuff builds trust, builds confidence that your investors, one, know what you're doing, obviously, but you're putting yourself out there, you're sharing what you know, but you're also making yourself a resource to those people that have invested in you and invested in your company, which I think goes a long way. So again, kudos to you and what you've built and are building there at People's Capital Group. So now that we just got into 2026, how do you see the New Jersey market? I know you kind of touched on it earlier, kind of we're in this little trough or at this opportunity zone that you feel you can get some good deals and good values, but what is your outlook maybe for the next 3 to 5 years on what your focus is at the company?
I mean, right now, like I said, I think it's time to buy. Prices are down 20%. Rent has grown substantially. For the first time in a while, cap rates are decent in this North Jersey market. I don't think it's going to last forever. I think we're going to probably have a new Fed chairman in, May, and he's going to probably be bullish on dropping rates some more. The Fed just dropped rates 3 times this year or last year, essentially, and that's going to now be reflected, I think, more and more in rates this year. So we'll probably see rates continue to tick down slowly but surely. And that in turn will push cap rates down also and prices up. Rent is a little stagnant right now. It's not going to last forever. A lot of inventory came to market in the last 2 years, kind of from the COVID boom where money was cheap and real estate was super hot and the equity was flying into development and all these buildings got off the ground. So all this Class A real estate hit the market in the last 2 to 3 years. And that has caused, a good amount of inventory in a lot of markets. Not as much in North Jersey, but, other markets were a little saturated, but that'll get saturated in the next year, ideally. And then I think we're going to start to see rents start to tick up again more aggressively, especially in high demand markets like North Jersey. And then what's going to happen is as rents grow and interest rates drop and prices increase, more and more equity is going to come into the real estate market, and prices will come higher and higher, and deals will be less and less attractive and harder to find. And there'll be more bidders and buyers and so on. So right now, I just see a great time. I think we have a year. I think this will be about a year. It'll last, maybe a little more, but a year and a half. But like for the most part, it's not going to be forever. Market cycle, and the market is down right now. So, granted, there's no like some unforeseen black swan event, which, these days seems like every 5 years or something. I wouldn't be surprised if like,
Hopefully not.
COVID #2 or like, I don't know, some terrible world wars. I don't know. But like, hopefully we avoid all that and things just kind of chug along, and we can move into better days of the real estate market. But I'm really not complaining. Like right now, this is the time to buy. It's like, if you don't know how to survive in a down market, then you're not a real estate investor. Like, you should get your pocketbook out and start buying real estate. This is the time to do it. And if it makes you nervous, then I don't know, get a day job. Like, then this isn't for you. This is a business. When times are rough, you got to buckle down and buy some deals and plunk down the cash. Like, this is it. This is the time. Because I've been through cycles. I started in 2010, and I just wish I bought more real estate from like 2011 to 2016, basically, and I didn't really have a lot of money or the relationships I have, so I was limited to what I could do. But I got a good inventory from that time, and I've refinanced a lot of those buildings like 2 or 3 times. They're worth like 4 times what I paid for them, and I just wish I bought a lot more of them if I knew then what I know now, right? So, and we're seeing that again right now for the first time in like 5 or 6 years. So take advantage of it. As far as beyond that, it's hard to say. I do plan to exit a number of assets into like 29, 2030. I think we're going to see better days then. That'll give the market plenty of time to kind of recalibrate, and we'll be in a good spot. As far as how fast do we get back to a bull market, it's hard to say, but probably something like 2 years is my guess.
Well, Aaron, thank you so much for sharing all of your wisdom today. One of the things you haven't really spoken about is, where can people get hold of you? If anyone's interested in this current investment, or being able to see those masterclasses, or just speak to you one-on-one, where can people go to get hold of Aaron?
Sure. So peoplescapitalgroup.com is a great place to start. We have all of our podcasts, our white papers, our ebooks, our webinars up there, and masterclasses, and our investment opportunities as well, our past performance. So peoplescapitalgroup.com is great. You can fill out a easy form to get on our investor wait list and get in touch with our team. You can schedule a call with them. You can also email me at aaron@peoplescapitalgroup.com. It's AARON at peoples with an S, capitalgroup.com. And our podcast is the Passive Cash Flow Podcast. So we're on all major platforms, iTunes, Spotify, YouTube. We have lots of like shorts and longer form content on YouTube as well. So you can just put People's Capital Group or Passive Cash Flow Podcast into YouTube. You can find us there. So yeah, we try to come out with a new episode every 2 weeks. And then if you're local, check out New Jersey Real Estate Network. Check out peoplescapitalgroup.com. Join our list. We'll send you an invite to our next event, which will be a building walkthrough in springtime here, probably around like April. And that's a good one. A lot of investors really like that. And we have our June big meetup there in Somerset, New Jersey. So if you're local, New York, New Jersey, PA area, give us a shout, connect with us, peoplescapitalgroup.com, and we'll hopefully meet you at an event.
You heard it here first from Aaron. I will be joining or putting my hand up for your events, for your walkthroughs. I know we talked about getting together in your office. Would love to see the operations you guys have there as part of our due diligence and partnership process. But you guys have been impressive, and it's really been a great pleasure meeting you and getting to know you a little bit further and what you've grown there. So again, we want to thank you for coming on the podcast. You shared a ton of valuable insights and knowledge, and I felt like we got a little bit of like what your class would have been like as a teacher here in this 45 minutes. Right? Very engaging and good content, good education. So people check him out, reach out to Aaron. He's great, and we thank you for coming back on, and we're excited for what you guys do this year.
Thanks a lot, guys. I appreciate it. Glad to be on.
Thank you.